You're listening to a CNA podcast.
Hey, it's Tiffany Ang here, starting the show for Andrea Heng on the Money Talks podcast. No, I'm not here to replace Andrea. I'm here to give you some quick financial updates as I usually do. We've got an educational one today. If I were to use a word to describe China's stock market this past year, it would be bumpy. So on this episode, Andrea will be finding out if this is a good time to consider putting money into cheaper Chinese stocks. Now, I know you hear this every episode, but we say it because it's important. Please follow us on Spotify, Apple Podcasts, or YouTube Music. That way, you can get an alert when a new episode drops each week. All right, let's start with some financial news, shall we? Climate vouchers. Heard about them? Minister of State for Sustainability and the Environment, Amy Khor, announced this week that families living in HDB flats will receive 300 Singapore dollars in climate vouchers from April 15th. So what are these vouchers for? They're for purchasing more efficient appliances. About 1.1 million HDB households will be given these e-vouchers, and thankfully they will come in a mix of denominations. You can buy 10 types of energy and water-efficient household products, including refrigerators, washing machines, air conditioners, and even LED lights. So it's perfect if you are thinking of replacing some of your household appliances now. But how do you know if these items you're buying are energy and water efficient? When you go down to the shops, look for the energy and water labels. The ticks will give you a good indication. Search for Redeem SG and claim your e-vouchers online. Well, speaking of incentives to save the earth, Tesla is now in an all-out price war with BYD in, of all places, China. The US electric vehicle giant is dishing out new incentives to woo customers in the world's largest auto market. Customers in China who buy selected models can get a maximum of $4,800 worth of incentives. These include discounts on car insurance products and body paint changes. BYD, if you need a quick refresher, is the Chinese electric vehicle juggernaut. It has responded with even greater discounts on its newer car versions. Honestly, I don't think this is a bad thing. It's good for the environment and, more importantly, for the buyer's wallet. And regardless of which side wins eventually, if you're buying shares with Tesla and BYD, you are also going to be the winner.
$7 trillion. Let that number sink in, because that's how much value has been lost in the Chinese stock market, namely China and Hong Kong listed equities, since their peak in 2021. The rout is so bad that the Chinese government has called for forceful, pragmatic actions to stop the bleeding. Even the man at the top, President Xi Jinping, could not stay idle, regulators briefing him on the damage. It's the start of the Dragon Year, and it appeared to bring some reprieve by way of, holiday spending and tourism. That tends to be the bellwether of Chinese consumption for the year. But this may not be enough because it's seasonal, right? So for now, the outlook kind of remains bleak, and with China's recovery set to be a slow, bumpy ride, or at least that's what people are telling me, we want to ask if now is a good time to consider pushing funds to cheaper Chinese stocks. Here to chat with us is John Lin, Chief Investment Officer for China Equities at AllianceBernstein. Hey John, thanks for coming down.
Thank you for having me.
So first, let's get a good understanding of what's happening in China. The headlines, they're so hard to ignore, right? They're screaming stock market rout, weak recovery, property crisis, big meetings among central bank officials, and then, of course, a briefing for the chiefs of China's Politburo. So things sound like they're getting serious. But let's look past the headlines. Tell me what's really happening in China in a nutshell.
Sure. I like the way you put it, right? Which is, let's look at what's happening in the economy first before you take a look at what's happening in the market, because we've been doing this a long time in China. And over a short period of time, the market is actually often disconnected from fundamentals. There's just so much emotion, both on the upside and I guess what we're seeing in the last 6 months, 12 months on the downside as well. So I think the important thing is to look at the economy and the companies and then the earnings.
Yeah.
What the company's actually earning. Because ultimately, when you're buying stocks, you are buying slices of companies.
That's right.
Yeah, you're not just flipping securities and hope, by
Exactly.
next Friday you can make, $2.
Exactly.
That's not the point.
Yeah.
And so the economy is slowing down.
Okay.
And part of that is cyclical and part of that is structural. So let's break that down a little bit.
Sure,
right?
yes.
On the structural side, Chinese growth model for the last 15, 20 years, as you probably have heard, a lot of that has been driven by this debt-dependent or leverage-fueled property almost. Developers borrow money, people borrow money to build house and buy house.
And then they pay back later.
They pay back later. And that all works when property prices are going up, etc. But the problem with that is you need an ever larger debt load to support that. So you got to borrow ever more and more money. So I think the authorities for quite a long time are quite keen to somehow reform this debt-dependent growth model to stop that.
Okay.
And they got serious really in the middle of COVID in 2021. The authorities putting a number of measures trying to curb leverage growth in property market. Long story short, those measures really worked.
Okay.
And it really popped the bubbles and it drove a large number of bankruptcies by private developers.
Yeah.
So today, if you look at the economy, there are parts of it that's doing pretty badly, and there are parts of it that's doing okay, if not spectacular.
Right.
And on average, they look bad.
Okay.
So what's a bit that's doing pretty bad is anything property related, right? I think at the peak of the economic cycle, or this is 18, 24 months ago, China was selling the equivalent of 1.6 billion square meters of houses. This is like a space.
That's
right?
a lot.
That's a lot.
Yeah.
In calendar 2023, this is last year, that's down to about 1 billion square meter. So 1.6 to 1, that's a pretty big drop. And then if you look at the brokerage or the sell-side analyst forecast in the marketplace, not our forecast, but the market's forecast, people are predicting that 1 billion last year falls to something like 800 million this year.
Ooh.
So it continues to fall,
Right.
but you notice that the magnitude of fall is starting to decrease.
Yes, that's right. I was just about to say the gap is a bit narrower.
Yeah, so 1.6 to 1, pretty painful, right? That's 600 million of construction activities disappearing, gone,
Yeah.
poof. Now, if you go from 1 to 800, that's 200 million. Still painful,
Yeah.
but a lot less than 600.
Yeah.
And then I think the trajectory is pointing to continued decline in the property space,
Right.
but maybe down to 100 sort of incremental decrease. So you can see anything in the economy that's related to housing.
Right.
And by the way, at the peak of the property contribution to the economy was something like a third of the GDP was property related.
Right.
Not just construction, right? But furniture and then any, you got to redecorate
There's a whole
your
ripple
house.
effect of industries that get affected by just the property crisis, because you're not just thinking about the grand buildings that they're building. It's a lot of jobs, it's a lot of materials, supply chains, and all, like you said, the furnishings involved. And I'm so glad that you clarified just how closely the property crisis is linked to the Chinese economy. The property market, or the contribution to the economy, to China's GDP, a third of that came from the real estate sector and its relevant industries.
That's right. And so you can see how the shrinkage of activities that we were talking about, 1.6 billion to 1 billion, all that stuff, shrinks that 1/3 of economy in terms of jobs, in terms of contribution to activities. But what about the other 2/3?
Yes, I was about to ask.
What's that doing?
Exactly.
And the biggest portions of those 2/3, one is obviously domestic consumption.
Yes.
And we all know China is a really big economy now. People dine now, they travel. There's just a lot of internal activities, service sector, etc. And they're doing okay.
Yeah.
Right? They are activities going on. This is not a picture of an economy that's in free fall, in implosion mode.
Exactly.
This is a slowing down, and parts of the economy probably just doing badly. Like consumption and services are, if not spectacular, they're doing okay.
Okay.
And there are parts of the economy like the industrial sectors, particularly those that are related to companies that have had a really good niche business, building buses, tractors,
Right.
forklifts. Those are actually doing quite well.
Okay.
They've seen revenues grow last year, especially from exports.
Right.
And exports not to making stuff in Zhejiang province and selling Walmart,
Yeah.
but rather making buses and making forklifts and sell that in Saudi Arabia.
Right.
What we call the global south today, or
Yes.
other emerging markets.
Right.
And that's a big growth driver, and that's humming. That's going well.
Right.
So if you then zoom out and look at the headline level, and you're averaging a third of the economy kind of shrinking in free fall, two-thirds of the economy kind of growing, but not spectacular,
Right.
the average number doesn't look good.
China did also have some of the strictest, longest COVID restrictions, and they were among the last, if not the last, to reopen. How much of this was a factor on the economic recovery?
Yeah, I think the COVID-19 pandemic had a very strong impact to the overall economic pictures today. But it's in somewhat more nuanced ways, and maybe two principal ways I can see that playing out. One is that it damaged particularly the SMEs, and we all know that in most economies, it's the small and medium companies, the medium enterprises are where all the jobs are.
Yeah.
And a lot of those are in moms and pop services, a restaurant you run on the corner of the street, etc.
Right.
Those were really, really hurt, and many were hurt to the bones during COVID-19 and related lockdowns. And so they take time to come back, and because they were hurt so much, some of them were not able to come back.
Yeah.
And therefore, some of the jobs related to that corner restaurant is gone.
Right.
And so that certainly hurt consumer sentiment, and that hurt the balance sheet of companies, and that hurt ability of people to spend. Because if you don't have jobs, you don't have income. You don't
That's
have
right.
income, you don't spend money. Right? And if I link that to what we said earlier before, that's why the consumption activities is not falling apart, but not spectacular. The second portion of that is quite interesting because China actually gained a lot of market share when it comes to exports during COVID.
Yes.
Why is that? It's because if you remember, what happened back then was countries like the US, like Western Europe, even here in Singapore, the government actually hand out a lot of assistance, gave money to citizens of the respective countries to help them through that tough period. And what do people do when you're locked down at home, but people gave you a lot of money?
Yeah.
Is you spend. You
Yes.
you find stuff to buy online.
Exactly.
And so if you are American, you just got $2,000 in your mail, and you go, I'm going to on Amazon.com, I'm going to buy this and I'm going to that.
Exactly.
But who makes those things? Emerging market factories, right?
Yes.
Factories in China, Indonesia, and Mexico. But you know what? Especially the beginning part of COVID, Mexico was closed.
Yeah.
Vietnam was closed.
Yeah.
Cambodia was closed. What's open? China. Only China was open. So Chinese companies, especially the exporters, gained a huge amount of, I would call them, temporary market share.
Right.
Because all the other competitors were shut down.
Yeah.
And so they made a lot of money during that time. So that did two things. One is that gave policymakers confidence, in hindsight, maybe too much confidence, to crack down on the property sector because they looked at part of the economy and go, oh, look at these exporters. They're humming. They are making money hand over fist. They were paying a lot of money to the workers. Of course, that means I can crack down on the property sector because
Right.
the other part of the economy is doing fine.
So they thought that sector of the economy was enough to cover any losses that may have bled from the property crackdown.
That's certainly a factor,
Okay.
right? But then, of course, as we talked about, this is temporary because now we know Mexico is open,
Yeah.
Vietnam is open.
Competition's back in the game.
Competition's back.
Yeah.
And so some of that extra business that exporters were doing were gone.
Right.
And so that's actually accelerating or contributing to the downturn that we're seeing today. But again, that's probably temporary because you gain something temporary,
Yep.
you lose that. So there's sort of one-time effect, and that ought to normalize over time.
There's this question I have about whether China's repressive policies towards fintech, e-commerce, online gaming, even the education sector, could that have been a contributing factor as well to the rout we're seeing today in China?
I think it certainly does. And principally about confidence by investors. And these are not just global investors, but local investors. And investors in the market is like one thing. and they like certainty. Anytime that certainty goes away, you start to price things a little bit lower, you decrease valuation. But then let's sort of zoom out and look at the history of Chinese policy making when it comes to businesses. And we've been doing this for a long time. We've been looking at Chinese companies for a decade and a half. And there's one thing that's very consistent, which is the Chinese government or the policymakers are always a factor in every business regulation and in a way that the business is allowed to earn money.
Right.
That's just the way it is.
Okay.
And if investors aren't comfortable with that, they ought not to be in China.
That's a good
Because
point, yeah.
That's unlikely to change.
Yeah.
But I think what happened was there was a period of time, particularly just before COVID, there was a lot of global money coming to China, and they, I think incorrectly, thought that here are a set of companies, your e-commerce tech of the world, that are exposed to middle-class Chinese consumer growth, but, quote, immune from government policy meddling.
Right.
Now, the first part is true. The second part, we emphatically think is untrue.
Yeah.
And then, of course, what we found out is then all businesses are the same.
Exactly.
They're all exposed the same way.
Yes.
So I think that sort of realization came from the fact that people forgot about history, or a new set of investors who come in who aren't used to it. And so I do think you need to have that on the ground understanding, the grassroots research.
Yeah.
But then one must not forget that then you have to look at the impact of some of these regulations on companies and the volatility or the uncertainty that comes with this policy making by itself actually can create money-making opportunities for us. A good example of that would be this education industry crackdown. And if you look at some of these companies that were at the eye of the storm of the crackdown, your after-school tutoring schools that are listed on the Hong Kong Exchange, for example, or in the U.S., it's been, 3 years now since that policy came out.
Yep.
And if you look at their P&L over the last 3 years, you can barely see the impact of those.
Oh, wow.
So the regulation really scared the market. The stock fell a long way, and then boom, the stock came back because, as it turned out, it wasn't that big of a deal in terms of regulation. So had you done the homework and the research, there's actually a decent amount of money-making opportunities in these type of policy changes and the market overreaction. And if you take a step back and look at particularly the way global investors have been viewing China, and I think this is partly what's contributing to the bearish sentiment we're seeing today, which is they looked at the slowing economy, they're looking at the uncertainties that come from policy making, and some are concluding that China is no longer investable.
So what's your response to that then? Is China uninvestable?
When one Chinese sees another during the Lunar New Year, you say 恭喜发财,
Right,
or
right.
恭喜发财,
Yeah.
literally saying, I hope you make a boatload of money.
Yeah, okay.
This is a culture
Yep.
that prizes the entrepreneurial spirit. They congratulate each other for making money, for finding the opportunity to make money.
Right.
I think this is at the core of any good equity market environment, which is, can you find people, can you find businesses that are good, that are organized and geared in a way that want to make money for its shareholders? If you don't have that, forget about it. That market is not investable.
Yeah.
I would argue that 恭喜发财 means this is a market that for the last 2,000 years and for the next 1,000 years, I would bet, will always have people who are very geared toward finding good business opportunities and monetize them. And because that's the case, invariably you can find good investments as an equity investor.
Right.
Therefore, China is imminently investable.
Okay.
Right? That's the angle I come from. It's not looking at some of these short-term hiccups, etc. It's, can you find good business opportunities? And I think the answer is yes.
Okay. And since you answered yes, which sectors would these be in, especially pertaining to the individual investor or even a regular investor? Where should I be looking?
Yeah, some of the companies that we found that have been working well last year and so far are really well this year. And what I mean working well is not just that the share price is going up, but really the earnings.
Right.
What we care about is, are the companies making money and growing despite whatever the environment they're in? And many industrial companies that we found are really quite interesting. And these are industrial makers of construction equipment or buses or heavy-duty truck diesel engines that over the competition in the last 20, 30 years, emerged out of the competition in China as some of the best maker of their products in the world.
Right.
And so today they have a foot in the China market by being a leader in bus making or forklift making or whatever it is, but also another foot in exports to emerging markets. We like that because today, as we talked about, the domestic China market isn't all that strong, but it could come back. And so we want to have that optionality to participate in the upside.
Right.
But while China is in the recovery phase itself, these companies are able to earn and continue to grow through exports. We all know Saudi Arabia was going through this giant construction boom right now.
Yeah.
And I'm sure people talked about property boom in Dubai.
Yes.
All those things need construction machinery, and they are all Chinese. And so here is a way to participate in a construction boom in the Gulf,
Right.
in the Middle East.
Okay.
Another one is dividend yielding companies. Good old-fashioned, boring, stable cash flow yield. And other than the fact that it's stable and it gives you cash back, which, who doesn't like that? There's an additional phenomenon, which is the domestic Asian market in China historically don't care about dividends. Historically, investors in China really reward companies are growing and growing fast.
Okay.
They don't care about companies paying dividend back.
Right.
This is very different than places like Hong Kong or Singapore,
Yes.
a much more developed market.
Yes.
And that's because China used to grow much faster. So it's all about growth.
Right.
But today, China is no longer the high growth go-go market.
That's right.
So dividends becoming priced just like it is in Hong Kong and Singapore.
Right.
But the valuation is only catching up. It hasn't reached that same high valuation that it is in Hong Kong and Singapore.
But it has the potential to.
But it has the potential to. So we like that.
Okay.
It's one of these catch-up maturing stories as China becomes or converge to that of the behavior of other markets.
So one of the sectors that I was told to look into when it comes to Chinese stocks is the EV space, where there is significant growth. But here comes the important part for our listeners. When China's chips are down, is this an opportunity for us to buy in the EV space?
We think the EV space is really interesting, but maybe not all parts of the supply chain. So I think you have to be really quite careful.
Okay.
You take an EV in your mind, break that up into components.
Right.
Zoom that out into sort of like Thanos, snap a finger, and then this whole thing disaggregates.
Yeah.
So you can then visualize the supply chain all the way back to lithium mining,
For the batteries.
to battery making, to battery assembly, to assembly of the car.
Okay.
So actually all the way to charging pylons, etc. So the competitive landscape is very different in each part of that. So what we're seeing right now is an enormous amount of competition when it comes to electric vehicle because
Indeed.
everyone and their grandmother has launched electric vehicle models.
Wow.
And when that happens, the revenue or the volume is growing because people are changing, and this is structural. It's make no mistake. We believe that EVs are the future. But during this phase of intense competition, you also make less money. And so I think that one ought to look carefully at the supply chain and the intensity of competition in different parts of it.
Right.
So you've got to disaggregate each part of the component and buy those companies that not only grow, but get to keep the profit from the growth
Right.
instead of competing that way. Because otherwise, you are much better off being a driver of BYD than necessarily the investor.
That's a funny one. That's a good one. What's the profile of investor that can and should be in China?
First of all, when it comes to investing, one ought to think long term. And so trying to trade in and out of an asset class or even a stock on sort of this week or this month, that's a hard task.
Yeah.
Right? And can I call the market bottom this month versus next month? I don't think we can. It's a very difficult task. Some do it really well, and that's why they're fabulously rich. But generally speaking, that's a hard task.
Right.
The way we think about China is one is a large, deep market full of interesting business and business people. And so you ought to be able to find good companies if you look carefully. And then second is that the Chinese market itself tend to have a very different rhythm than other big markets like the S&P, etc. And so that means in a well-balanced portfolio, there usually ought to be a place for something like a Chinese equity because it provides that nice diversification. Put it differently, when things are working really well for your S&P stocks, China might not, like it's the case for the last 2-3 years.
Okay.
And if you think about before those 2-3 years, it's actually the reverse.
Exactly.
When China worked really well and maybe US was having a little bit of hiccup. And so I think for investors who want a well-balanced portfolio with a long-term time frame, it is a nice asset class to have a think about.
Okay, interesting. I want to look into the future now, just to round up our conversation. What have China's officials done so far to stop the bleeding in the stock market? What's the future going to look like given the current circumstances in China?
That's a good question. And the government actions when it comes to supporting the economy or supporting the market, and those are not the same thing, by the way. So I think we ought to look at those two separately.
Okay.
But if you look at the market supporting policy so far, as you said, there is really no public announcements about government is doing this or that. But we can glean from some of the market behaviors, trading volumes in certain instruments, to guess that, and this is just a guess, that the government has been intervening in the market, or what they call national team, has been sort of supporting the market, but through buying ETFs. And as a participant in the market, we would generally think that the market should be allowed to discover its own price, right? We believe that's the best way for the market to clear, which is you and I agree on a price, and I'll sell you something and you sell me something, and that's a precursor to what's needed for a nice functioning market.
Okay.
So direct market fiddling is never something that we really would advocate for.
Okay.
At the same time, I think if indeed they are buying ETFs, that's a lot better than what they've done in 2015, which is coming into the market and pick winners and losers randomly, or through a system that we don't understand, trying to buy individual stocks.
Right.
And so that's what's happening to the marketplace. But by far, the things that we like to see as an investor is really supportive policies when it comes to the economy. Because if the economy stabilizes, or property sector stabilizes, corporate earnings recover, you don't need to put any money in the market. Money comes of its own accord from all corners of the world, because who doesn't like to buy stocks that go up?
Of course.
Right? And so we would think that in terms of policymakers, the best use of China's resources is probably finding places where the government's funds or capitals or resources can have the most impact in terms of stabilizing the growth picture overall, whether it's parts of the property market or parts of the economy that are most beneficial in terms of those supporting policies to create things like jobs.
You have been a massive help in mapping out the dots of the Chinese stock market for us. I've come away with more knowledge now than we did when we first started this conversation. So thank you so much. It wasn't an easy task.
Thank you so much. Thank you for having me.
And as always, a big thank you to you as well, listener. If you found this episode especially helpful, we would like to know. We're streaming on Apple Podcasts, Google Podcasts, and Spotify. We're also up on YouTube Music. So if you have the time and you're listening to us from any of these platforms, leave us a rating and a comment. For Money Talks, the team is Joanne Chan, Tiffany Ang, Crispina Robert, Junaini Johari, Saya Wint, and I'm Andrea Heng.